Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Oklo.
If you find our talks useful, please consider subscribe, like, and comment underneath. Right, so let's look at the bigger picture for a second here. If you're building a portfolio for the next decade, you're inevitably looking at the huge infrastructure build out for artificial intelligence.
Oh, absolutely, it's unavoidable.
Yeah, but there's this silent crisis happening behind the scenes of every new data center. AI requires just a staggering continuous supply of electricity to run all those processors. And while our current power grids just cannot handle the load that's coming.
Right, they really can't.
So the market is currently hunting for solutions right at that intersection of surging energy demand and next generation nuclear power.
And that intersection is, it's arguably the most critical bottleneck in the modern economy right now, and it's exactly where Oklo has positioned itself. But for anyone tracking this stock, it has been a deeply turbulent ride.
Yeah, that's putting it mildly.
Right. We're talking about extreme volatility that has shaken out a lot of those early investors.
Which brings us to our mission today. We need to figure out if the current price of this stock is, a value trap that's just going to keep dropping, or if this is actually a deeply discounted entry point for a speculative long-term hold.
Exactly.
And to answer that, we really need to understand what this company actually does, because we aren't talking about those traditional massive concrete cooling towers from the 70s, right?
Yeah, not at all.
Yeah.
We're looking at a pre-revenue advanced nuclear startup. Their primary focus right now is commercializing what the energy industry calls first-of-a-kind technology.
Okay.
Yeah, their flagship product is known as the Aurora Fast Neutron Reactor.
Okay, wait, let's break that down for everyone, because fast neutron reactor sounds a bit like, science fiction.
It does.
How does that actually differ from the conventional nuclear reactors that power the grid today?
Well, it really comes down to how the reactor utilizes fuel. So traditional reactors, they burn a fraction of their uranium fuel, and then they leave behind this radioactive waste that needs to be safely stored for, thousands of years.
Right, the stuff nobody wants in their backyard.
Exactly. A fast neutron reactor operates differently. It uses unmoderated high-speed neutrons, which allows it to actually fission or split the heavy isotopes that traditional reactors just leave behind as waste.
Oh, wow. So in plain English, the Aurora reactor is designed to recycle and burn spent nuclear fuel.
That is the goal, yes. And it runs on a specific type of fuel called HAEU, which stands for high-assay low-enriched uranium.
HAEU.
Yeah, right. Normal reactor fuel is enriched to around, 3 to 5%, but HAEU is enriched between 5 and 20%.
So it's much more concentrated.
Exactly. Because it's more densely packed with fissile material, it allows the reactor itself to be much smaller, much more efficient, and run for way longer without needing to be refueled. The ultimate aim here is to provide zero-carbon baseload power.
And just to clarify that term for anyone who might not know, baseload power means it's running 24 hours a day, 7 days a week.
Right, it doesn't stop.
Yeah, it isn't dependent on the wind blowing or the sun shining. It's constant, reliable electricity, which is exactly what a data center needs to keep its servers online.
Perfectly said.
But beyond the reactor design, the competitive moat that really stands out to me here is their business model. They're taking this vertically integrated approach.
Yeah, that vertical integration is what truly separates them from other modular reactor startups. Most of their competitors, they're basically functioning as manufacturers.
Right.
They want to build a small reactor and sell it to an existing utility company, kind of the same way Boeing builds a plane and sells it to Delta.
Oh, I see.
But Oklo intends to own and operate its own powerhouses and sell the power directly to the end users.
Wait, I want to make sure I'm wrapping my head around this. So instead of just building an engine and selling it to a car company, Oklo is like building the engine, putting it into a car, and then running the entire Uber fleet themselves so they can collect the fares directly.
That analogy captures it perfectly. They are adopting a direct utility model. By selling the electricity rather than the hardware, they're positioning themselves to capture recurring long-term revenue over decades.
Rather than relying on those one-off manufacturing sales.
Exactly.
But the obvious question is, do massive corporations actually want to buy direct nuclear power from a startup? I mean, the evidence seems to point to yes, right?
Oh, definitely.
Look at their partnership with Meta. Meta has formally partnered with Oklo to deliver 1.2 gigawatts of nuclear capacity by 2034.
Yeah, and to put 1.2 gigawatts into perspective, that is roughly enough electricity to power nearly 1 million homes. Yeah. Securing a commitment of that size from one of the largest data center operators in the world is just a monumental validation of that direct-to-consumer utility model. And, they recently backed up that commercial momentum with a very tangible regulatory milestone.
Oh, you're talking about the U.S. Nuclear Regulatory Commission license.
Yes, the NRC. They granted a license to Oklo's subsidiary, which is called Atomic Alchemy, allowing them to handle and sell isotopes.
Okay.
Now, isotopes have crucial applications in medicine and industry, but the real significance here is the regulatory breakthrough itself.
Right, getting the government's stamp of approval.
Exactly. While the main Aurora reactor is still working its way through that long, complex approval pipeline, this specific license gives the company its very first actual revenue stream.
And it also demonstrates that they actually know how to navigate the U.S. regulatory framework, which, as we know, is notoriously slow and complicated.
Painfully slow, yeah.
I mean, a lot of theoretical competitors look great on a whiteboard, but have never successfully gotten a piece of paper signed by the NRC.
Right, and that regulatory head start just cannot be overstated. It proves execution capability in an industry where, frankly, red tape is often the biggest barrier to entry.
Okay, so the Uber-style utility model sounds great in theory, and the Meta partnership shows the demand is absolutely there. But actually owning and operating a fleet of nuclear powerhouses requires a mountain of upfront cash, right? Long before a single cent of electricity revenue comes back in.
Oh, massive amounts of cash.
So how are they surviving that initial cash burn? Because looking at their recent earnings report, the financial realities are pretty stark.
They are. The numbers certainly reflect the cost of deep tech development. For the full year of 2025, they reported a net loss of $105.7 million.
Ouch.
Yeah, and to give you a sense of the acceleration there, that's up from a $73.6 million loss in 2024. Furthermore, their operating expenses more than quadrupled, hitting $139.2 million.
That is a huge jump.
It is. In the fourth quarter of 2025 alone, their earnings per share came in at a negative 27 cents, which actually missed Wall Street's estimates by 10 cents. And the forecasts aren't showing a quick turnaround either. Analysts are modeling a negative EPS of 8.2 for the current year.
Okay, I have to play devil's advocate here. Usually, if you're an investor and you see a company's losses widening by millions of dollars, operating expenses literally quadrupling and earnings missing estimates, your instinct is to walk away.
Sure, absolutely.
I mean, how is this not just a massive, uncontrollable cash bonfire?
Well, if you were looking at a traditional software company, that kind of burn rate without corresponding revenue would be terrifying.
Right.
But we have to factor in what the market calls a fortress balance sheet. Oklo ended 2025 with approximately $1.4 billion in marketable securities, cash and cash equivalents.
$1.4 billion?
Yeah. And on top of that, some analyses calculate their pro forma liquidity, meaning the cash they have on hand, plus near-term expected capital inflows at closer to $2.6 billion.
So they have an absolute war chest.
They do.
But even with $1.4 billion in the bank, are they just feeding it into the furnace to kind of brute force their way to market?
In a way, yes, but it's a highly deliberate deployment of capital. In the world of advanced nuclear technology, there's this phenomenon known as the Valley of Death.
The Valley of Death.
Yeah. It's the massive financial gap between having a working prototype and getting the first commercial unit built and approved. The sector is just full of startups with brilliant reactor designs that went bankrupt simply because they couldn't afford the decade-long construction and regulatory phases.
Ah, so that $1.4 billion isn't just a safety net, it's actually a competitive weapon.
Precisely.
It allows them to survive the Valley of Death while all their competitors essentially starve.
That is the core financial thesis here. They've provided guidance for $350 million to $450 million in capital investments for 2026, alongside $80 to $100 million in operational expenses. Because of that massive cash pile, they can aggressively fund their engineering, their regulatory filings, and the initial construction without needing to constantly go back to the market to raise more money.
Which would obviously dilute the value of existing shareholders' stock.
Exactly. The liquidity effectively eliminates their near-term funding risk.
Okay, but if they have a validated business model, the NRC head start, and literal billions in the bank, why has the stock experienced such a brutal crash?
Right, the elephant in the room.
Yeah, let's talk about that 60% drop because, I mean, the chart does not look pretty right now.
The technical damage over the last few months is severe. Late in 2025, the stock went on this parabolic run, peaking near $174. But it has since corrected sharply, dropping roughly 60% and recently trading at a 9-month low in the $45 to $49 range.
And if you look at the technical indicators, the stock is currently trading below its 20-day, 50-day, and 200-day moving averages.
Yeah, across the board.
And for anyone who doesn't follow technical analysis, think of a moving average as a trend line that shows the stock's momentum over a certain period. When a stock is trading below its short-term, medium-term, and long-term trend lines, it means the momentum is consistently pointing downward. Sellers are just in total control.
Yep.
All that speculative enthusiasm from when they first went public has just been completely washed out.
And a significant catalyst for that downward pressure was a very public, very vocal bear case published by the short-selling firm Kerrisdale Capital.
Right, I saw that.
The critics laid out a few major arguments. First, they argue that Oklo's management team just lacks the specialized, decades-long experience required for a mega project of this magnitude.
Okay.
Second, they believe the company's internal timelines for securing the final NRC licenses for the Aurora powerhouses are completely disconnected from historical reality.
Meaning they think Oklo is promising investors a finish line that the government regulators are never actually going to let them cross that quickly.
Correct. But the most critical risk, the bear case points out, is physical fuel availability. We discussed earlier that the Aurora reactor relies on HLEU fuel.
Yeah, the highly enriched stuff.
Exactly. The problem is there is currently a global shortage of it.
Wait, why is there a shortage? If this is the fuel of the future, why aren't suppliers just, making more of it?
Because enriching uranium up to that 20% mark requires highly specialized facilities. Historically, the global supply chain for enriched uranium relied heavily on international players, specifically Russian state-owned infrastructure.
Oh, I see where this is going.
Right. With the shifting geopolitical landscape, Western nations are scrambling to build up domestic enrichment capacity. But you can't just flip a switch and open a nuclear fuel plant overnight.
No, I imagine that takes years.
It does. And Kerrisdale argues that because of this bottleneck, Oklo's assumptions about how much their fuel will cost are just wildly optimistic.
And if the fuel costs drastically more than they projected, well, their unit economics just fall apart. I mean, it doesn't matter how great your Uber fleet is, if the price of gasoline goes up 10 times, you're going to lose money on every ride.
That's the fear.
And to make matters worse for investor confidence, we saw the CEO sell approximately $23 million worth of his shares in January of 2026.
Yes, we did.
I mean, if you're a retail investor reading about global fuel shortages and inexperienced management, and then you see the CEO cashing out tens of millions of dollars, how is that not just a blaring fire alarm?
It's entirely rational to see that and feel panic. But when we dig into the specifics of that trade and the broader context, a really strong counter-narrative starts to form.
Okay, let's hear it.
First, let's look at the actual mechanics of that CEO stock sale. Those shares were sold at $99.25.
Wait, that is essentially double where the stock is trading right now.
Which completely changes the implication.
Right.
If management believed the fuel shortage was an unsolvable crisis and the company was heading for bankruptcy, we would likely see panic selling near the bottom. Selling at nearly $100 after a massive, rapid run-up in the stock price looks much more like standard profit-taking.
Okay, that makes sense.
Furthermore, if we look at who actually owns the company, institutional ownership remains incredibly high at roughly 85%.
That means the massive hedge funds, the mutual funds, and institutional banks are still holding on to their positions.
Exactly.
The smart money hasn't run for the exits despite the 60% drop.
They're holding steady. And beyond the ownership metrics, the fundamental news coming out of the company has actually been quite positive. For instance, they recently expanded a strategic partnership with a Swedish company called Blykalla.
Okay, what does that do for them?
This agreement brings a commitment of $100 million to $200 million strictly in engineering resources.
Oh, wow. So, addressing Kerrisdale's criticism about execution and experience, Oklo is actively importing massive amounts of external engineering talent and capital to ensure they can actually build these reactors.
It is a direct response to the execution risk.
Yeah.
And Wall Street analysts seem to be weighing this cash and execution strategy pretty favorably against the bear case.
Have price targets shifted?
We have seen some firms trim their expectations, sure. Needham lowered their target to $73, H.C. Wainwright to $90, and Craig-Hallum to $71. But the average consensus price target among analysts still sits at $84.30.
which implies nearly a 100% upside from the current $45 level.
Exactly.
And you still have major firms like William Blair reiterating an outperform rating, specifically pointing to that $1.4 billion fortress balance sheet we discussed. They believe the company has the financial armor to just weather the storm.
Which brings us to the most actionable part of this analysis, which is the upcoming catalyst calendar.
Okay, what's on the horizon?
The market isn't just going to wait years for revenue. They're looking at the next 3 months. The major event everyone is tracking is July 4th, 2026. That's the target date for the initial operations of the Groves test reactor.
Why is that specific test so vital to the stock price?
Because a successful test fundamentally de-risks the technology in the eyes of the market. It proves to investors and, to regulators that they aren't just pushing paper and running computer simulations. It proves they have tangible, working hardware that operates safely.
Right. And there's also these massive macroeconomic currents at play here regarding government regulation.
Definitely.
There is significant market speculation surrounding the incoming Trump 2.0 administration. Now, the market broadly perceives this incoming administration as highly focused on deregulation and aggressively pro-nuclear.
Yep, that's the sentiment.
Furthermore, Oklo board member Chris Wright has been nominated as Energy Secretary. Now, I want to be incredibly clear to our listeners here. We are not taking any political sides or endorsing any administration's policies. We are strictly observing how the financial markets are pricing in these events.
Right, exactly. We're just looking at the market reaction.
And objectively, the market is viewing the potential for a friendlier, faster regulatory environment at the NRC as a massive sector-wide tailwind.
The market hates uncertainty, and any potential acceleration in permitting is viewed as a huge bullish catalyst. And when you combine the possibility of faster regulations, the upcoming July test reactor, and the current beaten-down price of the stock, you get an incredibly explosive dynamic.
Really explosive.
Right now, the short interest on the stock sits at 12.22%.
Let's explain what that actually means for the share price. When you have 12% short interest, it means over a tenth of all the available shares have been borrowed by investors who are actively betting the stock will drop further. Think of it like short sellers stacking sandbags on top of a pressure valve to keep the price down. But here's the catch. If a positive catalyst hits like a successful reactor test in July, those short sellers have to scramble to buy the stock back to cover their tracks and close their positions.
Which creates a friend.
Exactly. That forced buying creates a massive upward wave called a short squeeze. It just blows the sandbags right off the valve.
And we actually saw a brief preview of that mechanic recently with an 8.7% single-day rebound driven purely by a slight shift in market sentiment.
Oh, wow.
Yeah. When a stock is technically oversold at a 9-month low and heavily shorted, any piece of undeniably good news forces those short sellers to become buyers. The recent 60% drop suggests that a lot of the worst-case scenarios, the licensing delays, the fuel shortage concerns, are already priced into the stock at these levels.
All right, we have covered a lot of ground today. We broke down how the Aurora reactor recycles fuel, the vertical integration moat, the massive cash runway, the fuel supply bottleneck, and all the upcoming catalysts. Let's synthesize all of this into a clear investment thesis for everyone's portfolio. What is your final verdict here?
Well, based on the balance of the Fortress balance sheet against those regulatory risks, we're looking at a bullish score of 7 out of 10.
7 out of 10, okay.
Yeah, this is a high-reward, high-risk play. Because the stock is currently technically oversold, it presents a potential entry point, but your target horizon must be a speculative long-term hold of about 2 to 3 years.
Got it.
The true ultimate payoff for this company depends entirely on the successful commercial deployment of the Aurora reactor by late 2027 or 2028.
So the strategy is essentially trusting that their $1.4 billion cash pile will act as a safety net while you wait out the long, bumpy road of regulatory execution. You just have to have the stomach for extreme volatility.
That is the trade-off. The risk-reward skew has shifted favorably for patient capital, but the road there will absolutely not be a straight line.
Let me leave you with a final thought to mull over today as you look at your own portfolio. We talked about Meta signing an agreement for 1.2 gigawatts of power. Think about the sheer staggering scale of that for a second. If massive tech hyperscalers are willing to lock in dedicated nuclear energy contracts a full decade in advance, securing exclusive power for the year 2034, what does that tell you about the future?
It's a huge signal.
Right. Right. It tells you that the architects of the AI revolution are quietly looking at their own future energy needs and realizing the current grid will never survive it. The energy race to power the next century of computing has already started, and the biggest players on the planet are placing their bets right now.
Absolutely.
Thank you for tuning in to analyze the market and build smart wealth with us. We'll catch you next time.